Hello everyone, welcome back to our channel. And if this is your first time, a big hello. Today we are embarking on a journey to understand the very foundation of the business world, which is accountancy. This easy to understand material has been thoroughly created by a student just like many of you, a BCom first year student. This also shows that grasping these fundamental concepts is absolutely achievable, and we are going to break it all down together. Okay, so are you ready to unlock the secrets of business finance? Let's get started. Okay, now our first question is, what exactly is accountancy? Well, as this slide beautifully puts it, accountancy is the process of identifying, measuring, recording, classifying, summarizing, interpreting, and communicating financial information. Do you understand that? It might sound a bit technical, right? Let's just simplify it. Okay, let's read it one by one. Okay, now accountancy basically is a process of identifying. Now this means figuring out which activities involves money. For example, when a company sells a product or pays its employees, those are financial activities. So that is identifying. Okay, it's a process of identifying. Second thing is measuring. Now this involves putting a specific monetary terms on those activities. For example, if a company sells a product for say 1000 rupees, the value of that transaction is 1000 rupees. Okay, the second process, this is the second part of the process involved in accountancy. Now third part is recording. Okay, now recording is about writing down all the financial activities in an organized way. For example, you keep a diary of all the money that comes in and goes out. That is called recording. Okay, next comes classifying. Now classifying means grouping similar financial transactions together. For instance, for example, say all the money spent on salaries will be classified as salaries. Now all the money which we have received from sales will be classified as sales. Okay, that is summarizing. Classifying, sorry. The next step is summarizing. Now this involves taking all the recorded and classified information and presenting it in a shorter, easier to understand format. This is often done through a financial statement. Okay, for example, summarizing, what we do is basically when we prepare profit and loss account or a balance sheet, that is called summarizing. Okay, the next step in the process in the accountancy is interpreting. Now interpreting this is about understanding what the summarized financial information means. That we prepared that summarizing P&L account and balance sheets together. So interpreting basically will explain us, okay, to understand those statements. Okay, now if the company is making profit, is it spending too much money? Okay, that is what is the process of interpreting. The last process is communicating. Okay, finally this involves sharing the information with people who need it, like the company's owners, investors, or even the government. Understood? Okay, in simple terms, accountancy basically helps businesses know how much money they have, where it's coming from, and where it's going. It's essential for making good decisions and understanding the financial health of the organization. Okay, in simpler terms, it's about keeping track of money and business activities. Okay, now for example, think of any business, big or small, they all have money coming in and money going out. Accountancy is a system they use to make sense of all that. In that way, accountancy is also called language of business. Just like we use the language to communicate ideas, businesses use accounting to communicate their financial health and performance to various people. Okay, now let's go to the next topic. Now we understood what it is. Let's talk about why accountancy is so important. Okay, it is not just for the big companies. it touches many aspects of our lives as well. For example, for individuals, now understanding basic accounting principles can help you manage your personal finances effectively. For example, thinking about say budgeting, understanding your income, your expenses, making smart investment decisions. Okay, all this will be easier if you understand accountancy. Okay, now for businesses. Okay, for businesses, for any business to actually succeed, accountancy is absolutely crucial. Okay, it helps them make informed decisions about things like say pricing, production, expansion, etc. It also allows them to track their performance. For example, are they making profit or are they making losses? It is also essential for securing say bank loans or loans from lenders. Okay, they will want to see their financial records, and also financially businesses they also need to comply with various regulations and tax laws which require accurate accounting. That is the reason this is also important for businesses. Now for the economy, on a larger scale, accountancy basically plays a vital role in the economy. Okay, it provides say transparency in financial dealings, which basically builds trust and helps in overall economic growth. When businesses are transparent about their finances, it creates a more stable and reliable economic environment. Okay, now next. So who are the people who actually use this language of business? Let's take a look. Number one are owners and managers. Now these guys are the primary users. Okay, they need to see how their business is doing day to day. They need to make strategic plans for the future, and also assess if they are meeting their goals. Okay, and investors, if someone is basically thinking about putting their money into a company, they will heavily rely on accounting information to make a decision if it's a good investment. They want to see if the company is profitable and financially sound. Okay, now they use this accounting information. And creditors, or say they can be banks or money lenders. Now when a business needs to borrow money, either from banks or from any other lenders, they basically use accounting information to assess the risk of lending. Okay, they want to be sure that the businesses can repay the loan, so they also use accounting information. Now government, the government needs this accounting information for various purposes, primarily say for taxation, that is to ensure that businesses are paying the correct amount of tax, and for regulatory purposes, to make sure businesses are actually operating within the law. Okay, last, the employees. Even employees have an interest in the financial stability of their company. Okay, to actually know if the company is doing good or not, even to understand the impact on their job security, potential for raises, and the overall well-being of the organization they work for. They use this accounting information. Okay, now let's basically touch upon the different branches of accounting. Okay, now think of them as different specializations within the field. Generally accounting is say categorized in three different parts: financial accounting, cost accounting, and management accounting. Now financial accounting is the most common type you will encounter. If someone says accounting, 99% of the time they mean financial accounting. Okay, it focuses on summarizing, analyzing, and reporting financial transactions. The main goal here is to prepare financial statements like the income statement, the profit and loss accounts, the balance sheets, which are often made available for public consumption, meaning anyone who can take a look at it. Okay, next, cost accounting. Now cost accounting is all about understanding and managing costs. Okay, it involves recording, classifying, analyzing, summarizing, and allocating costs associated with producing goods and services. This information basically helps businesses control their cost and make decisions about pricing and production. Cost accounting will basically decide what the price of a product or a price of the service will be. Okay, that is basically decided in cost accounting. Financial accounting basically decides if your company is making profits or losses. Now third is management accounting. Unlike financial accounting, which is often for external users, management accounting provides financial and statistical information specifically for managers within the organization. Now this helps them make day-to-day and short-term decisions, improve their efficiency and plan for the future. Okay, now let's go to the next topic. Now, okay, objectives of accounting. So what are the main goals or objectives of doing all this accounting? So it's good that we are doing accounting, we are trying to understand what accountancy means and everything, but why are we doing it? What is the purpose of accounting? Okay, what is the objective of accounting? Spelling error there. Let me, objectives of accounting. Okay, now the first is to maintain records of business. Now this is the fundamental purpose. Accounting provides a systematic way of recording all the financial transactions of a business in what we call the book of account. Now this creates a historical record of all financial activities. So the main objective of accounting is to maintain records of business. Okay, number two is calculation of profit and loss. Now one of the primary objective of any business is basically to make a profit. Okay, now one of the primary objectives of accounting is to determine the financial result of the business over a specific period, whether it has earned a profit or suffered a loss. Okay, this is crucial for understanding the business performances. Okay, now next, basically to ascertain the financial position of the company. Now business owners and other stakeholders, for example investors, are also interested in knowing the financial health of a business at a particular point in time. Okay, now this also means understanding what the business owns, what it owes to others, and the owner's stake in business. Okay, basically what is the financial position of the business, how much the other people owe them, how much this business owes others. Okay, how much the owners has put a capital. Okay, everything can be ascertained. So that's one of the objectives of accounting. Now providing information to users. The accounting information that is gathered and processed needs to be communicated to all the interested parties we discussed earlier. Okay, now what were the interested parties? If you just go down, these are the interested parties: owners and managers, investors, creditors, okay, government and employees. So accountancy basically provides the information to all these users. Okay, through different reports, they also make statements, graphs and charts. Everything is made through accounting, through different parts of accounting. Okay, let's go to the next part. Okay, now let's basically now try to understand basic accounting terms. Now you have basically understood what accounting means, why it is used, what are the objectives of accountancy, and who uses it. So if you understand these basic accounting terms, it will be easier for you to understand the whole subject of accountancy. On a daily basis, you will basically listen to new terms in this subject. So these are some of the basic terms which I'll try to put an explanation on. Okay, now this is also called accounting vocabulary. Understanding basically these terms is like learning the alphabet of the language of business. Okay, let's go through them one by one. Business entity. Now this means a specifically identifiable business enterprise. In accountancy, what you have to understand is the owner is different from the business. This will explain in the concepts of accounts, which probably in the next video will explain. Okay, So their entity is different, business entity is different, and owner is different. So okay, business entity, think of it as basically treating a business as a separate individual from its owner for accounting purpose. For example, if you own a bakery, the bakery is separate from you personally. Okay, so when you are making an accounts for yourself, it's your personal account. But when you are making an account for bakery, it's bakery's account. So the entity is bakery. That is a business entity. Okay. Now, second is business transaction. Any business dealing or event that has a value that can be measured in terms of money and involves the transfer of money or something worth money between the business and others is called a business transaction. For example, buying supplies, selling goods, paying rent, all these are business transactions. Okay, next is creditors. Now, a person or entity to whom the business who owes this money is a creditor. Let me repeat that again. A person or entity to whom the business owes money is a creditor. For example, if your business buys goods on credit from a supplier, the supplier is a creditor. Your business needs to pay him money. Okay, so that's a business loan sort of thing. We can't term it as a business loan, we call it a creditor. Okay, now debtor. Debtor is a person or entity who owes money to the business. It's exactly opposite to the creditor. So debtor means a person or entity who owes money to the business. So if your business sells goods to a customer who promises to pay later, that customer is a debtor. Okay, now the next terms are debit and credit. Now these are the main terms which you use in the accountancy. Debit and credit. Every transaction has two sides. Listen to this very carefully. Okay, every transaction has two sides, a receiving aspect and a giving aspect. The receiving aspect is called a debit and a giving aspect is called a credit. Okay, this is basically the foundation of the double entry system, which we'll explore in more detail later. But think of it like a seesaw. For every action on one side, there is a corresponding action on the other side. That is what double entry bookkeeping is. So debit and credit goes simultaneously. Okay, now next is capital. Capital basically refers to the money or assets that the owner invests into the business. It's also known as owner's equity and represents the owner's claims against the business. Okay, earlier we said business entity. Okay, the owner actually has to be separate, different than the business itself. Okay, so when you say capital, it is the owner's money invested in that business. For example, when you open a bakery, you invested 1 lakh rupee. Now that 1 lakh rupee is called capital. You might have 10 lakh rupees personal money, but you just opened a bakery with 1 lakh rupee. So that 1 lakh rupee is the capital. That business owes you 1 lakh. So that is the capital. Okay. Drawings. Now the amount of cash or other assets that the owner withdraws from the business for the personal purpose is called drawing. It basically reduces the owner's capital. Now when you invest say 1 lakh rupee in a bakery, you start a bakery by putting 1 lakh. This 1 lakh is capital. And every month if you start taking say 15,000, 20,000 out of it, that is called drawings. Okay, now the drawings can be in monetary terms or in any other terms. The value of that transaction is your drawing. Okay, the next term is revenue. Okay, this represents the money of a business. Okay, this represents the money a business earns from its primary operations. Okay, is the total money earned from say your primary objective, like say selling product or providing services to its customers. For example, our university, the total revenue of Andhra University is through fees. Okay, major revenue is through fees, so that is revenue. Okay, so sales are usually the major source of revenue. Okay, it can be say interest received or commission earned or rent collected, etc. Now next is income. Now, income is basically the increase in the net worth of an organization, whether it's from regular business activities or other activities. Okay, now for example, income, when I say, it's basically a broader term that includes profit as well. Okay, that is income. It basically increases the net worth of an organization from regular business activities or other activities, all activities included. Next, let's go to expenditure. Now this is basically, expenditure means spending money or taking on a liability to receive some benefit or property. Okay, so for example, paying rent, salaries, or purchasing say goods or machinery is expenditure. Let me repeat that again. Expenditure means spending money or taking on a liability to receive some benefit, service, or property. Okay, so examples are paying rent, salaries, purchasing goods or machinery. These are expenditure. Now expense basically means, this term denotes the cost incurred by the business in process of earning revenue. Okay, now think of it as a day-to-day cost of running the business. It could include wages, salaries, rents, everything. Okay, now expenditure includes expense. Expenditure is a broader term. Okay, expenditure is, say for example, if I actually am buying an machinery, that is an expenditure, but that doesn't fall under expense. Expense is basically an expense on a day-to-day activity. Okay, let's go on another terms. Okay, now these are important: profit and loss. Now profit is basically what is left over when a business's total revenue, not income, when the business's total revenue exceeds its total expenses. It represents an increase in owner's equity. Okay, now let me repeat that again. Profit is what is left over when the business's total revenue exceeds its total expenses. If your total revenue is say 1 lakh, your total expense is say 90,000, your profit is 10,000. That is profit. Loss is exactly opposite. This occurs when a business's total expenses exceeds its total revenue. Okay, it basically decreases the owner's equity. Okay, it can also refer either to money or assets lost due to events like theft or fire. Okay, generally I'll tell you, loss basically happens when it is excess of expense over revenue. So your revenue was 1 lakh, but your total expenses were 1,10,000, then you are making a loss of 10,000 rupees. Okay, now there are also, this term is also used when you lose money because of theft, okay, or say due to events like say fire, etc. Loss in fire is also considered as loss. Okay, let's go to next terms. Assets. Now let's comes to the balance sheet terms, assets and liabilities. Okay, now assets basically are the material things or the possessions or properties that the business owns. Okay, which includes say money owed to it. Okay, now we can classify basically assets into two categories: fixed assets and current assets. Fixed assets are assets that are used for a relatively longer period to carry on the business and help generate income. They are not meant for resale, like say for like buildings, machineries and furniture. Okay, and current assets, these are the assets that are held for a very short period, usually with an intention of converting them into cash or using them within a year like say cash in hand, accounts receivable, inventory. Okay, all these are current assets. Okay, now let's go on for liabilities. These are the obligations or debts that a business has to pay at some point in the future. It's the amount of business. It's the amount a business owes to others. Okay, assets, what we have. Liabilities, what we are supposed to give. Assets, what we are supposed to receive and we have. Okay, like debtors. Okay, liabilities are what we are supposed to pay or we have to pay later. Okay, like loans and everything. Okay, now even liabilities are basically divided into two: long term liability and current liability. Long term liability, these are liabilities that are payable after a long period, typically more than a year, such as long term loans. For example, if I am taking a home loan, personally if I take a home loan, it is 10-year loan, 15-year old, that is a long term liability. So if a business takes a loan, okay, 5-year loan, 10-year loan, it is a long term liability. Okay, now current liabilities, they are liabilities that become due and payable within a shorter period, usually within a year. They often arise normally from day to day business, like accounts payable. Say for example, creditors or debtors. Creditors is a current liability. Okay, now what happens is, for example, I have purchased a product to sell. I purchased 1 lakh rupees worth of product from Ramesh. So I have to pay that 1 lakh rupee for purchases of goods within a short period of time, say 2 months, 3 months, 5 months. So those are current liabilities. Salaries, if not paid, they are current liabilities because I have to pay salary next month, if not this month, next month. Rent, electricity bills. Apart from expenses, if I am not paying it this month, they are current liabilities. They are not long term liabilities. Okay, unpaid rent, unpaid salaries, unpaid bills, all these are current liabilities. Next is discounts. Now discounts basically are deductions allowed either on a selling price or on the amount due. Remember this again, discounts are allowed either on the selling price or on the amount due. Based on that, they are divided into two: trade discount and cash discount. Okay, now the concession given by the seller for making a bulk purchase, it is called a trade discount. Okay, for example, if you go to Big Bazaar or any other shopping place, they'll give you a trade discount. If you are say buying 5,000 worth of goods, they'll give you 10% discount. That is a trade discount. Okay, that is a simple example. Cash discount, this is a discount deduction granted by the creditor to the debtor as an incentive for making a prompt payment. For example, if any of you are using say credit cards, if you make a prompt payment on time or before time, they'll give you cash discount. In business, what happens is, for example, someone owes me say 1 lakh rupees. Okay, so what I tell them is, say if you are paying me 1 lakh rupee now, you have to pay me say after 5 months or 6 months. But I can tell you, I can give you a cash discount. If you are clearing the dues now, instead of 1 lakh, I'll take 95,000. So I'm giving 5% cash discount. Okay, cash discount is also if you are buying products on cash. Okay, so if you are buying say a product on credit, the price might be different, and if you are buying a product on cash, the price, if it is different, the difference is called cash discount. So if you are buying a product in cash, if they give you a discount, that is called cash discount. Okay, we covered a lot of ground today, from the basic definition of accountancy to the whole bunch of essential terms. Okay, understanding these fundamentals is the first step in your journey into the world of business and finance. I would recommend, if you have not understood this video or some terms, rewatch it again. Okay, and if you found this video helpful, please give it a thumbs up and subscribe to our channel for more educational content. We'll be diving deeper into this concept in future videos. Let us also know in the comments below if you have any questions or if there are any specific topics you would like us to cover. Okay, thank you so much for watching. We'll see you in the next video.